Welcome to The Explainer. Today, we're diving straight in and putting on our analytical hats to run a thorough financial checkup on a true veteran of the Indian mutual fund industry, the Aditya Birla Sun Life Large and Midcap Fund. It's been around since 1995, but listen, we aren't just looking at its history for the fun of it. We're actually going to use this specific fund as a masterclass to teach you exactly how to evaluate mutual funds for your own long-term capital growth. So whether you're a total novice trying to figure out where to park your capital or an informed investor looking to sharpen those diagnostic skills, you are absolutely in the right place.
Here is our roadmap for today: wealth planning and multipliers, inside the fund structure, benchmarks and peer comparisons, volatility and market capture, unpacking key risk metrics, and finally, the bottom line. Let's get to it.
Section 1, Wealth Planning and Multipliers. All right, let's start with the absolute dream scenario, right? The magic of compounding. If you're putting your hard-earned cash into the market, you're probably asking the big question: how long is it actually going to take to 10x my money? For a beginner investor, this is easily the most exciting part. It's one thing to hear someone tell you to invest for the long haul, but what does that timeline actually look like when rubber meets the road? Well, looking at the historical data for this fund over its incredibly long lifespan gives us a pretty fascinating answer. Check this out. It took just about 3 years and 11 months to double the capital. Not bad, right? But the really mind-blowing part is that bottom row. It grew capital by 10 times in under 11 years. Literally just under 11 years to 10x. It completely takes this abstract idea of wealth planning and makes it incredibly real. It's hard proof that long-term capital growth really is all about letting time do the heavy lifting for you. Moving on to Section 2, inside the fund structure. So how exactly is this fund built to target those kinds of massive returns? We got to look under the hood at the allocation. What we're looking at is essentially a dead-even split. We've got 44% allocated to your massive, ultra-stable large-cap companies and another 44% right there in mid-cap companies. You know, those mid-sized businesses that still have a ton of room to run. Then you sprinkle in a 10% allocation to small caps for a little extra growth kicker and a 2% buffer in cash, and you've got the whole shebang. Now, why does this 50-50 split matter so much? Well, it's absolutely crucial because it perfectly balances that large-cap stability with mid-cap growth. If you're a slightly more conservative investor wanting to manage risk, but still, chase some meaningful returns, this structure is honestly ideal. The large caps, they are your anchor during economic storms. The mid caps, they're your engine during the market rallies. It essentially acts as a giant portfolio shock absorber, letting you participate in growth without fully exposing yourself to the wild, unpredictable swings of smaller stocks. All right, Section 3, benchmarks and peer comparisons. But hey, having a good structure is only half the battle, right? Execution is the other half. It's checkup time. We need to contrast our patient's current vitals against the broader market to get a real diagnosis. And, well, looking at the 5-year annualized returns as of early 2026, we've kind of got a problem. The Aditya Birla Fund delivered 11.01%, while the category average surged way ahead at 15.52%. Plus, the benchmark, the Nifty LargeMidcap 250 index, has also hovered significantly higher. So rolling returns show us this fund has unfortunately lagged quite a bit, pointing to a structural performance issue that really kicked in around early 2022. And when we stack it up against major peer funds, the gap gets even more glaring. While ABSL is sitting at 11.01% with about 5,100 crore rupees in assets under management, you've got absolute giants like Kotak, SBI, and ICICI Prudential delivering anywhere between 16% and 20% over that exact same 5-year period. And they're doing it while managing vastly larger pools of capital. It is a stark reality check on exactly where competitive capital is thriving right now in the large and mid-cap space. Let's dive into Section 4, volatility and market capture. To figure out why it's lagging behind those peers and the Nifty benchmark, we got to put the fund through a bit of a stress test. Let's look at recent market volatility. Look at this number, negative 20.23%. Ouch. That represents the fund's maximum drawdown recently, meaning the absolute worst-case drop from its highest peak to its lowest trough before bouncing back. If you're a beginner trying to assess long-term capital growth, this metric is a must-know. It literally tells you exactly how much pain your portfolio would have endured during recent market stress. But this next data point, this hits the nail on the head when it comes to diagnosing that lag. We're talking about capture ratios, basically how a fund performs relative to the broader market index. The upside capture here is 91. That means the fund only captures 91% of market rallies. It leaves 9% of the gains just sitting on the table. But wait, it gets worse. The downside capture is 104. So when the market takes a hit, this fund bleeds 104%. It drops more than the market does. Underperforming in the good times and dropping harder in the bad times, yeah, that's the mathematical root of those trailing returns. Moving right along to Section 5, unpacking key risk metrics. Let's drill even deeper into those vital signs. If you really want to master fund evaluation, especially for conservative investments, you have to unpack these specific risk factors. Now, before I throw more numbers at you, you've got to know this term, Jensen's alpha. Simply put, think of alpha as the pure, raw value the portfolio manager adds beyond just riding the market's natural wave. If a fund just copies the market, its alpha is 0. Positive alpha, the manager's actively picking winners. Negative alpha, their picks are actually dragging the portfolio down compared to the benchmark. So, applying these metrics to our patient here, the fund has a beta of 0.99, which means it moves almost perfectly in sync with the overall market's volatility. Then its standard deviation sits at 15.36. That actually shows slightly lower volatility compared to its category peers, which is definitely a point in favor for conservative investors. But there's the elephant in the room, a negative alpha of negative 3.12. So despite keeping volatility somewhat in check, that negative alpha confirms the fund has really struggled to generate those crucial excess returns through its stock selection in recent years. Finally, Section 6, the bottom line. Okay, so what's the overall prognosis? We've seen the incredible historical highs and the bumpy recent stumbles. Now let's talk turnaround strategies and what this entire diagnostic exercise means for your own long-term wealth planning. Here's the big advantage on the horizon. The AMC has brought in a highly qualified new fund manager, Vishal Gajwani. He is actively transitioning the portfolio toward a GARP framework. That's growth at a reasonable price. By hunting for specific bottom-up catalysts, like corporate deleveraging or management changes, he is directly aiming to fix those historical misallocations and generate some serious future alpha. And that brings us to the ultimate question for any investor holding a lagging fund. I want to leave you with this provocative thought to challenge how you manage your own capital. When the data clearly shows a fund underperforming its peers, do you pay the opportunity cost of waiting for a new manager's turnaround strategy to kick in? Or is patience, remembering that amazing 10x multiplier we talked about earlier, the ultimate winning strategy? You can use all these diagnostic tools we covered today, capture ratios, alpha, beta, peer comparisons, to evaluate the funds sitting right now in your own portfolio. Do that, and the answer for your specific wealth plan will become crystal clear. Thanks for joining me on this explainer, and keep learning.